A thrift bank, also known as a savings and loan association, is a financial institution that offers essential banking services, savings options, and mortgage loan services. S&Ls typically are private institutions owned by customers or shareholders, though some are publicly traded companies. They receive savings from individuals and use those funds to provide loans, primarily residential mortgages. Savings and loan associations originated with the building societies of Great Britain in the late 1700s. The building societies circumvented the traditional banking system by allowing members to buy shares and borrow against their value when they purchased a home. The societies began to borrow money from people who did not want to buy homes themselves and became permanent institutions. Building societies spread from Great Britain to other European countries and the United States. They are also found in parts of Central and South America. Why would you trust a savings and loan association? S&Ls are also known for more competitive interest rates and better tailored customer service. Historically, thrifts have offered higher interest rates on savings accounts compared to banks, thanks to the low interest funding they get from the Federal Home Loan Banks. Additionally, savings and loans associations are usually smaller institutions compared to other mortgage lenders, concentrating on growing home ownership and meeting the financial needs of local consumers. Backed by low-cost government funding, the S&Ls were able to offer long-term home loans at fixed interest rates, the 30-year mortgage as we know it today. In 1980, there were approximately 4,000 savings and loan associations. But how did a sector once as stable as your savings account spiral into chaos? Let's turn the clock back to the early 1980s, a notable period of transformation for S&L. The relatively greater concentration of S&L lending and mortgages, coupled with a reliance on deposits with short maturities for their funding, made savings institutions especially vulnerable to increase in interest rates. Inflation rates and interest rates both rose dramatically in the late 1970s and early 1980s. This produced two problems for S&Ls. First, the interest rates that they could pay on deposits were set by the federal government and were substantially below what could be earned elsewhere, leading savers to withdraw their funds. Second, S&Ls primarily made long-term fixed rates mortgages. When interest rates rose, these mortgages lost a considerable amount of value, which essentially wiped out the S&L industry's net worth. Though a bit later, S&Ls began to recover somewhat as inflation and interest rates began to decline. But the basic problem was that regulators did not have the resources to resolve institutions that had become insolvent. For instance, in 1983, it was estimated that it would cost roughly $25 billion to pay off the insured depositors of failed institutions. But the Thrift Insurance Fund, known as the FSLIC, had reserves of only $6 million. Many insolvent thrifts were allowed to remain open, and their financial problems only worsened over time. They came to be known as zombies. Moreover, capital standards were reduced both by legislation and by decisions taken by regulators. Federally chartered S&Ls were granted the authority to make new and ultimate riskier loans other than residential mortgages. The industry's problems, though, grew even more severe. Ultimately, taxpayers were called upon to provide a bailout, and Congress was forced to act with significant reform legislation. Imagine waking up to a financial system on the brink of collapse. The catalyst was deregulation, a move that turned conservative savings and loans into high stakes gamblers. Couple this with sky high interest rates and an oil crisis, and the stage was set for disaster. The early 1980s brought a sea change for S&L as part of the broader trend toward deregulation on the financial industry. Many of these rules and restrictions governing S&L were loosened. This deregulation was meant to encourage growth and innovation, but it also exposed them to new risks. The fallout was monumental. Over 1,000 institutions failed, a $160 billion taxpayer nightmare. This isn't just a tale of financial ruin. It's a lesson in the delicate balance of risk and regulation. That was the reality during the 1980s. Savings and loans crisis, a true economic thriller.